A. Thai. DXY VIX. A. DXY. Thai. VIX. /CH. N. Good evening, and welcome to our special financial market update. Today's global market, particularly U.S. equities, exhibited a classic risk-off, kill-off shakeout pattern, a scenario we assessed with an 80% probability. We saw a high opening followed by a significant decline, with capital decisively shifting towards cash, primarily the US dollar, and specific geopolitical risk hedges like crude oil. Simultaneously, there was a large-scale withdrawal from interest rate-sensitive technology growth stocks. This is a clear and unmistakable signal of risk aversion. Let's quickly recap the global market's trajectory today. Asian markets opened first, displaying a resilience quite distinct from what later unfolded in Europe and the US. China's A-share market saw all three major indices close in positive territory, with the Shanghai Composite firmly holding above the 4,000-point psychological level. Market sentiment initially appeared warm, and Hong Kong stocks also trended higher with some volatility. This suggests that during the Asian trading hours, capital either didn't anticipate or selectively overlooked the impending global risk aversion, instead focusing on regional positive factors. However, as European markets opened, they began to feel the pressure. While they initially carried some of Asia's earlier optimism, upward momentum quickly faded, and as U.S. equity futures weakened in the pre-market, European markets also turned volatile. The opening of the U.S. market proved to be the definitive turning point for global markets. After a brief initial surge, it declined steadily throughout the day, closing near its lowest point and completely reversing the optimism seen in Asia. The VIX Volatility Index and the US Dollar Index, DXY, both surged in tandem, unequivocally confirming the activation of a risk-off mode. Today's turning point was undoubtedly the U.S. equity market, acting not just as the emotional leader but also as the ultimate arbiter of global risk pricing. Asian markets, in this context, played a passive follower role, with their intraday strength actually forming a drag that was disconnected from global risk appetite, setting the stage for potential catch-up declines tomorrow. Delving into the expectation gap, the market completely disregarded the positive signals from Asian equities, particularly the A-share market breaking above 4,000 points. This is a classic case of ignoring good news equals underlying weakness, indicating that global macro traders have prioritized geopolitical events and the U.S. interest rate outlook over regional market performance. Pricing power has firmly landed in the hands of macro factors. Our assessment from yesterday's close that the market was shifting to a risk-off mode was correct. Today's movements further confirm that, in the face of a macro storm, regional market resilience is an unreliable short-term signal. The core reason lies in a misjudgment of market pricing priorities. The first layer of market pricing currently is geopolitical risk, directly reflected in the surge in WTI crude oil prices. The second layer is inflation and interest rate expectations, evident in the simultaneous strengthening of U.S. Treasury yields and the U.S. dollar index. Together, these two factors have created a double whammy for risk assets. Any analysis based on individual stocks or regional economies appears secondary within this overarching macro framework. Furthermore, a clear structural signal emerged today, with an 85% probability, the return of the stagflation trade. This implies that economic growth expectations have not improved, leading to falling stock prices, yet inflation expectations are strengthening due to oil prices, pushing U.S. Treasury yields higher, while capital flows into the safe haven dollar. This is